It's time for me to bring in Kumar, the CEO of Value Research. Thank you so much for joining us.
Thank you.
Well, it's been a very interesting week for us as retail investors and borrowers. On one hand, we saw the RBI give us a rate cut, and then after that, several banks readjusted their home loan lending rates, and that means a great deal for our, for our monthly budgets at home. Now, we also know the other reaction to that is that fixed deposit rates come down. Small savings rates have also come down. So anybody who's holding, post office savings, or you're somebody who invests in post office savings, this impacts you as well. Is it time for us to sort of put everything back on the table and re-look at the rates that we are getting, re-look at the kind of investments we're looking at?
Yes, absolutely. The primary, the big concern is about the people who are in retirement, the people who have invested their money in fixed income. They are deriving that income, and that is barely enough to support them now. And if that comes down, the inflation, of course, will come down. And, as the RBI governor has said, that the real return has to be more. But one has to see that how much of your consumption is elastic. A lot of savers do not, if your life is built around an income of, say, 15,000 rupees or, something like 13,500 rupees. And I really wonder that inflation coming down, how much potential it has to bring down your cost. And so if your consumption is not elastic, or if you can't do much about it, then you really have to revisit this, because one, the capital will be constant. You cannot, your income from that capital is coming down from fixed income, and you are completely risk averse, and understandably so, because your income, incremental income, you're not working anymore, deriving income from your investment. So one has to, look at it more objectively, how you have to take that risk, what you should be doing to enhance your return. If not enhance your return, how to ensure, because you have double challenge. One is to protect the worth of your capital if you're consuming oil investment, and particularly people who are dominantly, India has been a country of fixed income investor, and those investors who are just on the borderline of consuming all their income from fixed income, they need to really revisit. They need to look at hard times ahead, and I don't think there's an easy consolation for them.
In fact, the other set of people who should be looking at this very closely are those who prefer to use the PPF. Now, a lot of people I know assume that the PPF gives you a guaranteed return through the life of your investment of 15 years, which it doesn't. The government sets the rate of the PPF year on year. Should we keep an eye out for the rate of the PPF and see if there are going to be any changes as well? Is there a likelihood there?
Yeah, very much so, because all the things which is managed by a National Saving Organization, they are being, I don't know, it has been talked about that the government should look at it very seriously, but I don't think there is a need to do that, because it is all in process. Every year the rates on small savings schemes are being revised, whether it be PPF, NSC, Post Office MIP, Senior Citizen Savings Scheme. I think government needs to take a very hard look at what has happened to all the people in retirement who invest in such schemes. Maybe provide a window to some people, particularly the old people, and there is a scheme, the Senior Citizen Savings Scheme mandates that people with over 60 years of age can only invest. There's a maximum investment possible beyond which one cannot invest. You maybe retain that differential thing for old people, because I don't think they have easy way out, and I don't think we can actually educate them. The time is gone. They don't have time on their side. So I think creating a preferential rate of interest rate for those people up to a ceiling, even if it amounts to being a less modern economy, I think it will be worthwhile.
All right, so if you're someone who relies on fixed income instruments, FDs, small savings schemes, post office savings schemes, or the PPF, you're going to have to take a closer look at what those interest rates will be this year and over the course of the years to come. And we're here to help you if you have any questions about any of those investments. Let's take a look at our portfolio question for this week. 29-year-old Manu John Matthew has written in from the Middle East. He wants to build a corpus of 5 lakh rupees to refurbish his parental home in the next 5 years. But he has 2 other very big goals. He has his child's education in the next 6 years, for which he'd like to build a corpus of 10 lakh rupees and a combined corpus of 6 crore rupees for his retirement. Now, he sent us all of his financial details. I would like him to re-look at, some of the targets that he has and make sure that he's working in inflation. He also has some money in an emergency fund, fixed deposit, recurring deposit, mutual funds, and some surplus, and a couple of insurance policies. So the savings are going in. Would you like him to relook at his goals?
Yeah, it will be important, but I think, the roadmap should be very simple, and I think he has taken some steps in that direction anyway. It is good to save in something than not have saving or made those investments in the first place. So I think he needs to just be conscious of, what kind of expenses he has to plan for, and just reorganize his affairs, reprioritize his investments.
Right, reprioritize your investments. Narendra, let's take a look at his mutual funds. He has Birla Sun Life 95, iPru Balanced Advantage, the Reliance Liquid Treasury Plan, the Birla Sun Life Tax Relief, and the Reliance Equity Opportunity. He also has a couple of other, he has a pharma fund. He seems to have used a lot of, lump sum and then STP. It seems like a complicated portfolio. I want to go back to our fundamental rule on this show, which is to simply keep it really simple. Would you like to just recommend he uses one of our portfolios instead?
Yes, for a 29-year-old who has, all his goals which are reasonably long-term, he should seriously consider our aggressive growth portfolio or growth portfolio, and look at, revisit his portfolio. Maybe that 1 lakh rupee in the treasury fund, he can consider it as an emergency fund, so he may not, he can hold it, and it is a realizable thing at a day's notice in his bank account. And rest of it, he should, right now the focus should be that he should discontinue his ULIP, he should get an insurance, and get mapped to our aggressive growth portfolio or the growth portfolio.
All right, so our aggressive growth portfolio is on your screen right now. So is the growth portfolio. We'll have someone email it to you as well. And if you have any more questions, you can get in touch with us. But like we keep saying on the show, it's important to keep it simple. It's important to get aggressive into equity, especially if you have a longer time horizon, which you do. If you have any more questions for us, email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review, and we're looking at the Birla Sun Life Midcap Fund. Avan will give us a quick introduction. Avan.
Thanks, Faye. The fund in focus this week is the Birla Sun Life Midcap Fund. Now, midcap funds have been riding high, giving stiff competition to large and small cap funds in the past few years. While a slew of midcap funds have been launched in the last decade, Birla Sun Life Midcap is one of the oldest funds launched in the early 2000s. But how does its performance look when compared to the newly launched peers? The fund may have a strong fund house to bank on, but its performance has been average in the recent years. Let's take a quick look at its performance chart in the last 5 years. Now, the red line is the fund and the blue line is the benchmark, the CNX Midcap. You'll see that the fund underperformed its benchmark and its category until 2012 in both the bear and the bull phases of the market. With a change in management in 2013, the following years have been fairly good for the fund. In fact, it went on to generate a return of 73% in 2014, while its benchmark and category lagged in the performance chart. The numbers might be promising, but despite outperforming its benchmark and category in the recent years, the fund still lags behind its peers in a rising market. So is it time to give up on this fund and switch to a better performing fund? Let's find out. With that, it's back to you, Faye.
All right, Narendra, if you take a look at this fund, the performance in the last 1 year has not been bad. It's 3 stars on value research. Is this the sort of fund that, we can add to our portfolios as that mid-cap exposure? Are you happy with how it's handled the last 1 year especially?
No, last 1.5 years has been very extraordinary for these funds. Mid-caps have really run, and many funds have been able to capitalize it much better. This fund has beaten its benchmark by a wide margin, but is still lower than, the other funds in the category. And last month, the beginning of this month, we reviewed the mid-cap to sharpen it, our own fund classification. And now we find that, this fund is a reasonably average one compared to most others. And the kind of return which investors have been able to derive from mid-cap fund has been extraordinary. And this fund has, despite beating its benchmark, looks like a reasonably average fund.
But then for the investors who've been holding this fund for a while, if it's now an average fund, does this mean it's time for us to pull our money out and invest it in one of the funds that you recommend on the show?
Yes, generally speaking, when it comes to choosing a mid-cap fund or a small-cap fund, investors' expectation is very straightforward, that one is looking at aggressive return. And most mutual funds, who run this kind of fund, the mid and small-cap fund, they run it reasonably well. They provide all the kind of quality filters which an individual investor may not have access to when he is venturing on his own. And we have very credible alternatives available in this category. So investors with high expectation who invest in such fund, there are superior alternatives. This is not the finest one, and superior alternative, and there are quite a few.
Virendra, final question about this fund. What's your rating on Investor's Guide for this fund?
It is a 3-star fund. It's an average fund. It's not a disappointing fund, and it is not an extraordinary fund. And there are many extraordinary funds available in this category.
All right, 3 stars there for this fund on Investor's Guide. If you have any questions about the review that you just heard, feel free to get in touch with us. One last question before we let Virendra go, and this is our hold or sell segment. 28-year-old Anirban Chatterjee has written to us on our Facebook page. Now, he tells us that he'd like to save 25 lakh rupees in the next 5 years, 50 lakh rupees in the next 10 years. And he sent us a list of his investments, Virendra. 10,000 rupees going into a recurring deposit, 50,000 rupees every year going into the LIC, and 50,000 rupees every year going into the PPF. He's also putting money in the mutual funds. We're going to get to that in a bit. I'm a little unhappy with the debt investments that he has, and that's a huge allocation to go into those investments. Would you like him to sort of, at a man, his age, would you like him to relook at whether he should have that LIC and that PPF?
Yes, it requires a complete, rehaul of this, because he has a fairly defined expectation. In the next 5 years, he needs 25 lakh, and his 20,000 rupee going into mutual fund might well achieve that. But his money going into recurring deposit and PPF, and going in a manner for a 29-year-old, first he should cover his family, provided the protection he is married, and if he has financial dependence, he should quickly get that term insurance, get a health insurance, and have that emergency plan, whether it be emergency fund, whether it be 2 lakh rupee, 5 lakh rupee, whatever he deems fit, depending on his situation, and rest of the money should find its way conservatively. He can well choose a balanced fund for the money which he needs to accumulate for the next 5 years, in the next 5 years, and rest of the money which he needs after 10 years and more, that should find its way into the kind of fund which he has already chosen. They are very aggressive fund. They can potentially deliver substantially higher return.
But let's take a look at his investments, Virendra. Right on top, Franklin India High Growth Companies and Franklin India Smaller Companies. They're both aggressive funds. Should he continue both these investments?
Yes, very much. These are the two funds where he should have higher allocation, and these are the kind of fund which he should be keeping an eye. It should be allocated to his long-term goal, 10 years and more.
Franklin India Multi-Asset Solution, Virendra, continue this investment as well?
It's an interesting fund, but I really don't know how it fits into somebody's plan with precision. So he can do without this fund.
The next on his list is the Axis Long-Term Equity. This is the ELSS, the tax-saving fund. So I'm sure if he started it 6 months ago, he has to continue because he can't really take the money out at this point. But it's a good performer. He should continue that investment, shouldn't he?
Yes, he should not only continue this investment. In fact, if he is investing less money here, the money which he will discontinue investing in PPF and the LIC, on which he gets the ATC benefit, that money should also find its way into Axis Long-Term Equity Fund. It has been the outstanding tax-saving fund, and I hope that it continues to do the way it has done so far.
Next on his list, the iProof Focus Blue Chip Equity and the Kotak Select Focus, Virendra. Blue Chip Equity is a great fund. He should continue with that one. So what about Focus Equity? Would you like him to continue that as well?
Yes, both are large cap funds, and both are very impressive large cap funds, and I would say that he should continue investing, and this is the kind of fund, ideally, for his next 5 years, the money which he is likely to need in next 5 years should find he should be considering a balanced fund. But these are also fairly conservative vehicles, and right now I see a very bright outlook for the large cap funds.
Last fund I'm going to frown a little bit at, the Birla Sun Life Banking and Financial Services Fund, Virendra. Is that on the right track? Does he really need that fund given everything else we've seen in his portfolio?
banking and financial services fund have done very well, but I don't see any role for such a fund in any investor's portfolio who has a diversified equity fund or equity fund of any kind, because most equity fund have a sizable allocation to banking stocks, and normally the role of a sector fund is that your portfolio has a gap, your portfolio is low on something and you want to emphasize that and you don't know how to go about doing that, then you should have such a fund. I don't see any reason why a portfolio of 4 or 5 such funds which he already has needs to be supplemented by any banking fund.
All right, so the banking fund has to go, so has the LIC policy, the PPF. You can keep that RD, it could possibly work as a emergency fund for you, but move all of that money into these mutual funds and hold them for the long term, and you should comfortably achieve your goals. Dhirendra, thank you so much for joining us on the show and answering all of our questions.
Thank you.
If you have a question for Dhirendra Kumar, you know how to reach us. There's Twitter, there's Facebook, and there's regular old email. Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. We're going to answer your insurance queries now. Gajendra Kotari has joined us from Ertika Wealth Management. Gajendra, thank you so much for joining us. You love this first question. It comes in from a 24-year-old. Akash has written in. He tells us that he already has a group term policy of 15 lakh rupees from the company he works for. He now wants to buy a term plan, and that makes me so very, very happy. There's nothing better than buying a term plan when you're 24 because it costs brilliantly low at that point. He says he wants about 50 to 75 lakh rupees and he plans to top it up at a later stage. Now, considering most companies give out policies for 35 or 40 years, he wants to buy a policy with a longer life. He says that Edelweiss Tokyo has a policy that could give him a much higher term, but he's concerned because the company is so young. Almost, that's really brilliant. A really young man wants a more experienced company. Gajendra, should he worry about the age of the company?
Hi, Akash. First of all, I'm really delighted to see that at a very young age of 24, you are aware about these stuff, So term plan is a wonderful thing, and the sooner you buy, the cheaper premium you lock in. So that's good for you. So now for your income of 6 lakhs per annum, so you can get easily cover of around 1 crore per annum, 1 crore sum assured. And for you, the premium will be close to around 6,000 to 12,000 in between, So it's pretty cheap out here. Now you mentioned that of course you want the cover for the highest possible period. Now there are companies which gives up to 75 or 35 or 40 years as the maximum term. So of course when you're 24 plus 40 years term, your cover is ending at 64, so you're then left. One thing however you should always remember is that in term plan, the idea of buying a term plan is that up till you're working, if anything happens to you, the family gets the sum assured. So after retirement you don't actually require an income. So after 60, you don't require a term insurance for that matter. However, if you still want to go for a cover which will cover you in your retirement years also, then Edelweiss Tokyo is the only insurance which you rightly mentioned that gives you cover up till 80. So that you can go for. With regard to the credentials of the company, you don't have to really worry because all these companies are tightly regulated by the regulator, which is IRDAI. So your contract is absolutely safe and legal. So you don't have to worry. All you have to provide is the correct information, and you can be assured that all companies will pay the dues as and when it rises. Since you already have a group cover of 15 lakhs, so you can easily go for another 1 crore cover, and that should be able to help you. And you can review every 5 years, based on your salary, income, and your requirements and your liabilities, and keep adding the term insurance covers.
Our next question comes in from 67-year-old Raj Gopalan. He's retired. He says 14 years ago he retired as a bank officer. He has 2 health insurance policies of 2 lakh rupees each for him and his wife from United India Insurance. It's up for renewal in January next year. He wants to know if he should instead opt for a group insurance policy which the company is offering because it has a lower premium and it also might have a cover for pre-existing diseases. He wants to know which one should he opt for, or should he use the top-up facilities. Gajendra, what would you recommend? I personally like the idea of having individual policies because you're in control of it, but what would you recommend he does?
Hello, Mr. Raja Gopal. Since you already insured for 2 lakhs and this is the new group cover which you're looking for, I think without any doubt you should go in for the group insurance cover, because the good thing is that at such a low premium, 7,500, they're covering you for 4 lakhs. Another good thing is that they're covering pre-existing illnesses also. Since your cover 2 lakh is pretty low, you must add this, because that will enhance your overall sum assured. It's very difficult to get a top-up cover right now at this age, on the policies, and more so if you have any existing illnesses. Since you haven't mentioned this, I'm assuming you may not have. You can try with few Government of India companies if they can insure, as a top-up cover, but chances are very slim. But at least this group insurance cover will be really helpful. So you have a backup cover of this. So without doubt, you should go ahead with the group insurance cover.
Last question on the show. RJ Sergeant has written in. He tells us he's an overseas citizen of India looking for a term cover of 1.5 crore rupees for himself and his wife. He's worried there aren't enough companies offering these sort of plans because of his NRI status. He wants to know what he should do next. Gajendra, one option is to buy a local insurance policy from wherever it is he's living right now. But we know that Indian insurance policies tend to measure the risk of the country that you live in. What would you recommend NRIs do?
Hello, Mr. Sergeant. I can understand your apprehension and your concern. You being an OCI, as you rightly said, most companies are not willing to offer you term insurance covers. Of course, they're willing to offer you other products, but not the pure protection plans. So you have very few choices available with you. I think you can try and shop around, and there are few companies, if I'm not wrong, like Kotak Life Insurance and HDFC Life Insurance and maybe Max Life Insurance, which offers term insurance plans to OCIs. Of course, you have to be in India when you apply for this policies, because you have to undergo medical examinations and other procedures. But I think you can check with these few companies. 80-90% of the companies won't offer you this, but few companies may offer, and on case-to-case basis. So I think you can check with these companies.
All right, that's a wrap on Investors Guide. Thank you so much for watching. Remember, you can get in touch. There's an email ID. There's also the Facebook page, and you can reach me personally on Twitter as well. Thank you so much for watching.